Hi everyone, I'm Michael Mruger. I'm the managing partner at Greenbush Financial Group. As we get towards the close of 2020, our investment committee is now meeting to discuss what the moves are for 2021 and beyond, and we're reflecting on all the things that have happened in 2020. And one of the things that really kind of keeps coming back to glare us in the face is what's happened to the level of the government deficits in 2020, because they had to spend trillions of dollars, historic amounts, to really help the economy through the COVID crisis, where the deficits weren't great before, but now we've almost reached this point where it's not really an if we're going to have an issue in the future, it's more of a when. So we're now starting to build that timeline that we're going to share with you, because this could be really big. I mean, government deficits at this point have been a talking point. We've always talked about how they're an issue, now they keep going up, but it has yet to really have a personal financial impact on U.S. citizens, because taxes haven't gone up astronomically to combat it. They haven't done big cuts in government spending or other messes to bring those deficits down. But that could definitely happen in the next 5 or 10 years, which could influence the investment decisions you're making in your portfolio, the personal financial decisions that you're making with regard to how much debt you have, how you're living your lifestyle. So we're going to be going over some of those items today so you can start prepping that if we see this kind of monster surface for the next 5 to 10 years, you will be ready. So I want to show you some of the things we're looking at internally when we're trying to map out this timeline for the government deficits becoming an issue. And one of the things we look at as financial advisors is we look at probability of outcome. So this is kind of a bell curve, a standard deviation of what it would normally look like. And we make decisions based on these probability outcome curves in our everyday lives. And I'll give you an example. So this top of the curve is really the most likely event that is going to happen. So high probability, most likely event at the top. Down here is a tail, which this is kind of a very bad event that could occur. And then we have another tail over on the positive side, which are very good events that could occur. So here's a good example. So if you go to an airport, you anticipate that you're going to get to the airport, your flight's going to leave on time, and you're going to get to where you need to go. That is the most likely outcome, high probability, probably 80 to 90%. That's what you form your behavior around. There's also a very bad probability that you get to the airport and your flight never leaves and you don't get to go on vacation. While that's a possibility, it's a low probability in your mind, so you don't change your behavior based on it. And then you've also got the very good end, which is you get to the airport, there's not many people there, you get to stretch out on your row, they upgrade you to first class. Again, could happen, very good outcome, but maybe that's a 1% likelihood, where we're usually making decisions around those likely 80 to 90%. Now, if you are planning for a very bad outcome in that airport situation, you might anticipate that they're going to cancel your flight, so you might call their car rental company before you leave the house. Like, that is how that changes your behavior. Now, we as investment advisors do this same thing, where we look at the scenarios and variables in the market, we say, this is the most likely event that's going to occur over the next 1 year, 3 year, 5 years, 10 years, and we start to develop portfolios around that. We know these very bad events potentially exist out there, like the deficits, like we're talking about right now. But if we look at when they're lower, like, we don't really let those influence our current investment decisions because they're too far out, low probability of happening. But I can show you what's happening right now. What's happening right now is these tails, which are normal, very low probability, are actually moving up, which means the probability of them happening is increasing because the deficits are going up. So that means we could have a closer term event and have that negative impact, where this very bad event over here might have had a 1% chance before. Maybe it's 20% or 30% chance that we have a negative deficit event within the next 10 years. And this starts to influence the investment strategy, and there's just a lot more possible outcomes, which it makes it more difficult to plan from an investment standpoint. Now, when we look at actually the deficits, so where we are in this map, we measure deficits by debt to GDP ratio. So how much debt do we have versus how much do we produce in 1 year, which is our GDP. So what's the percentage? When we look at where we are for 2020, we just hit 100% debt to GDP. So we have enough debt to cover everything that we produce in one single year. And that's a huge number. when you look at the trend, it really started mounting up in 2004. It started increasing. That was the financial crisis. And then from here, this was COVID where it spiked up the rest of the way. The last time we were 100% debt to GDP was during the world wars. And we were financing a war at that point. So what you see is it peaked at 100% debt to GDP, but then you see it drop off because when the war ends, the spending stops, which is different about where we are now because there isn't just some single World War event that's going to end, that's going to decrease our spending, which is really a hazard going forward. And we know we're going to keep spending more and more going forward because when we look at the trajectory of our expenses, so the CBO kind of forecasts out how much they're going to spend each year. So for 2021, they expect to spend $5 trillion. But when we look at what they're spending money on, how they split it up, 50% of that is on Social Security, Medicare, and Medicaid. Not really negotiable items right now without making big law changes. So we look at 50% set in, and this is without adding any unforeseen government stimulus packages that are yet going to come in for 2021. When we look at the income we're going to have as a country in 2021, they see all the income from Social Security, and when you look at how much they're going to have to borrow, they're going to have to borrow close to $2 trillion just to meet the amount they plan to spend that's going to be added to the deficit. And as most debt, as the debt keeps getting larger, the amount of interest that you have to pay keeps getting bigger, and eventually all your growth goes back to just paying your interest. The government has essentially three options to avoid this mega debt crisis. The first is you cut spending, the second is you raise taxes, and the third is you could potentially inflate your way out of the debt. Even though the third option, inflating your way out, is being talked about, we don't see that as a viable option. I'm going to explain why. The main reason why I don't think inflating our way out of the debt is going to work this time is, one, we have too much debt anyways, but the main reason is how inflation works against some of our government spending. So when you inflate your way out of a government debt, essentially you're printing dollars intentionally to repay current debt, but by printing dollars, that puts more dollars in circulation chasing the same amount of goods and services. It intentionally creates inflation, which interest rates go up, prices go up. But if my debt is fixed, so let's say if I fixed debt of 100,000 at 3.5, I can print dollars. It doesn't matter that interest rates are going up because the interest is the same, and then I pay down the debt, then I'm done. The problem is what I just showed you is a big piece of the government spending is on Social Security, Medicare, and Medicaid. If inflation goes up, the COLA will go up on Social Security, which increases that cost. Medicare costs will go up. Medicaid will have to go up. So you're creating inflation to try and repay debt, but at the same time, your spending is going up just to keep pace with the inflation that you're creating. So it starts to become this vicious circle that never ends. Since that may not be a viable option, we then have to go back to the first two items, which is either the government has to cut their spending or they have to increase taxes. Both are not which are very favorable in the eyes of the taxpayer. If you're cutting spending, you're taking away something that someone has now. If you're increasing taxes, you're taking away income from income that people have now. You're going to get resistance on both those parts. And you essentially need a politician that stands up there and says, hey, I'm going to have to take this stuff away from you to stave off something that's going to happen 5 or 10 years from now that's very negative, which is probably the reality of it, but they're running against someone who's saying, hey, guess what more I'm going to give you? I'm going to give you lower taxes. I'm going to give you free tuition. Whatever they're offering, it's like people want more. So they're always going to go that way. So while we like to blame the political parties, the Republicans, the Democrats, the independents, they've all been spending more money than we've had for the last 20 or 30 years. At the end of the day, you have to turn the eyes on each individual and say, we would have to be willing to take some short-term pain as a country and really understand those ramifications to get by this government deficit issue that's looming there. And we just don't see that happening before the pain really comes from almost a government all-stop. I honestly don't think people are going to have a lot of heads up when it comes to when we actually hit this debt wall. Now, I don't think it's going to happen for the next few years because the government still has plenty of room to print money, but we talk 5, 10, maybe even 15 years, depending how far we make it along this road, it could happen very quick. And we're going to cheer it. We're going to cheer it all the way to the end because the stock market will go up, economy will go up, everyone's going to be doing well until the government can no longer print money, and then it's all going to stop abruptly. We saw it in 08, 09. Anything that's fueled by debt happens quicker than everyone thinks, and it's always deeper than everyone thinks. But it's important to remember that with this one, we're talking about the US government. Like 0809 was the banking system. Government stepped in, took all the bad debt. We never paid that back, still have it. COVID happened this year. They printed $3-4 trillion, stuff that in the economy, that's more debt. So they were able to backstop that. No one's there to backstop the US government. So when that happens, it's going to be forced spending cuts, forced tax increases, and they're not going to be small, gradual. At that point, we'll already have hit the wall. So they're going to have to be large adjustments. And the political view is going to be, hey, don't blame us. Like, they've known this was a problem for the last 20 or 30 years. I'm just the messenger, but this has to start happening now. Now, I made this video to create awareness. It's not to say, hey, let's scare the tar out of everyone and let's go to cash. But now that those tails have picked up, the higher the probability that there could be a government debt event within the next 10 or 15 years, you have to start recognizing it within your investment strategy, within your financial planning strategy. And what I mean by that is, if you're getting excess money in the form of lower taxes or stimulus checks or whatnot, instead of just socking it back into the market or purchasing more stuff, the strategy might be, hey, maybe I should pay down my debt a little bit, that if we hit something really rough 10 or 15 years from now, I could actually live off of 50% of the income I am now, so my family and myself will be okay over the long term. If you have any questions, of course, please feel free to reach out to us at moneysmartboard.com. Thank you.